everybody, and welcome to the Trading with Ashley show. Hey, I am wearing green. I am doing my part to get this market to turn around and start heading back up. Now, when you have several days of red in the market, it can be disheartening, I know, because I have been there. There with all of you. But I wanted to share something with you today. There is a way that you can take a trade that you were wanting to run the wheel strategy on, and you're waiting to sell covered calls on it, but it just won't go back up right away. That there is something that you can do. This is something that I thought of this morning. I shared it with my community, and it gave us more control over some trades where we were put the shares, but it's just not at the point to start selling covered calls yet. So let me explain to you what I have done, and you can use this strategy if you own 100 shares of a stock and you're waiting to sell covered calls on it. But first, let's create a baseline of understanding. When you are running the wheel strategy, you start by selling puts on a stock. If you are put the shares, then you wait for the stock to turn around and head back up. Then you start selling covered calls. If your stock is called away in profit, then you have made money. That's the wheel strategy in all scenarios. You made money on the premium from selling the put. You were put the shares. The stock rose. You started selling covered calls. The stock was called away. So you made premium on the sell of the covered call, and you made a lot of money on the appreciation of the stock from the point that you were put the shares to the point that they were called away. So that works really well in a variety of scenarios. But what happens if you're put the shares and it just doesn't want to turn around right away so that you can start selling covered calls? Well, that is what today's video is about. Now, I am constantly thinking of our community members, and I'm constantly thinking of various trades that we have taken and how I can help them maximize the opportunity in front of us. So this trade hack was one that I think they really enjoyed, and I wanted to fully explain it, and maybe you can take advantage of this yourself. So if you have a stock with 100 shares, instead of selling your traditional covered call, you can do a call credit spread on that stock. Now, most brokers, when you do a call credit spread, which involves a sold call and a purchased call, most brokers will attach that sold call to your 100 shares before it attaches it to the purchased call, which is fine. That works well in this scenario. So if you have a stock, let's say you have stock ABC, and you were put the shares at $100, you can turn around and do a call credit spread when you have your sold call maybe at 100 or 102, and you have your purchased call a little bit higher. Now let's talk through what will happen as the stock rises. Well, as the stock starts to rise and it gets closer to your sold call, well, that can be intimidating because you can see that that particular part of the trade is losing. But keep in mind, you have the 100 shares and you're always selling the sold call at or above your cost basis. So even if those shares are called away, they are called away at a break even or in profit because you did receive some premium to begin with on both the sold put and the sold call. But if it attaches to those 100 shares, now we have the purchased call that was part of that spread. Well, that can continue to run indefinitely as the stock rises, and you can get a lot more credit that way if the stock turns around and heads back up. So if you do a traditional, just a sold call, you should wait for a green day, because if you do that, you're going to get more premium and you're going to have the chance of a trade working out in your favor. But if you want to do this and secure the trade with a call credit spread, you can wait for a red day if you want, as long as the sold call is within reach, so that you're not taking a loss if your shares are called away from that particular part of the trade. Now, the reason that this works so well once the stock decides to turn around and head back up is you are purchasing the purchased call on a red day. And we all know from trading options, if you are purchasing calls, that it's best done on a red day. So if you do the trade this way, you can win in a couple of scenarios. Let's take the initial call credit spread. If by your expiration date, the stock price has not yet reached the sold call portion of the spread, well, then you get to keep all that premium that you created from doing the credit spread. But if it does reach the sold call, remember, you have 100 shares to attach to that. So those shares will be called away in profit. Now, at this point, you can go ahead and take profit on the purchased call that has also gained significant value from when you initially purchased it as part of the spread. I know it may sound a little confusing, but I wanted to explain it first before I take you into the computer and show you exactly how to execute this trade. Once you better understand options, you can use trade hacks like this to really help get yourself out of situations or at least make money while you wait for a stock to turn around. I hope it helps you. Let's jump into the computer and I'm going to show you what I'm talking about. We're going to start off with Sofi. So you must have 100 shares of Sofi and you want to definitely check your cost basis. So looking here at my trade, if I'm going to do this on Sofi, my cost basis is $27.95. So keep that in mind because more than likely I want to start at around the $28 mark for my sold call against my shares when I'm doing this spread. Here's an example of how you would build the credit spread. First, I do sell to open a call and I want to go out. Usually you want to go out about a month from now. That gives enough time for the purchase call where time decay is not a huge factor and it can continue to grow. So I want to start at my $28 strike because my cost basis was right there below 28. I don't want the call away to take place below my cost basis because then that would cost me. So here's that $28 portion of the trade. Then I want to go to buy to open because now I'm purchasing a call and it's for the same date. This time I'm going a little bit higher in strike. I'm going with the $30 strike. This is a $2 wide spread and typically it would require about $200 to make the trade. Putting these two trades together give me a net credit of 68 cents a share. Now because we're dealing with options, this is $68. Let's talk through the dynamics of the trade. If Sofi stays where it is today, or it goes down, or it goes up just a little, but it doesn't yet breach this $28 strike, then I win 100% in this trade. I get to keep the $68 as long as by my expiration date, Sofi is trading below 28. Remember, I also have those 100 shares, so I still have my shares too that I can do this again with. Now, if Sofi does rise, and let's assume that it pierces this $28 strike, well, that's okay because I do have 100 shares to back up this particular trade, and it will take my shares even if Sofi continues to rise. But don't forget, I also have this $30 strike. Now, this one will be worth a lot more than what I paid for it. Looks like I paid about $131. So over time, if Sofi continues to rise, then this will continue to rise as well. So although I capped my upside on the actual shares I had by selling the $28 call, now I get to enjoy the appreciation of this $30 purchased call. Now you'll have to decide at what point you want to take action on the trade. More than likely, I will be taking a look at this trade about a week before expiration and I will decide what I do. Do I go ahead and I allow the call away? And if I am going to allow the call away, then I could go ahead and take profit on this purchased put before time decay starts setting in. And then that sold put right up here, this will still be attached to my shares. And then when the trade expires, it will take them in profit. The most beautiful thing about this trade is it allows you to make money in either scenario, whether or not the trade goes up or down. And those are the kind of trade hacks that I like to do to help ensure that we can always take some action on our trades to try to make money along the way while we wait for the eventual turnaround in the market. I care so much about my community and I will do everything in my power to help them learn whether the market's red, green, or sideways. Remember, if you're with me trading with Ashley, there is no trader left behind. Now, if you want to be a part of all of this and get support throughout the trading day, regardless of what's happening in the market, consider joining my community. At the very least, I want all of you to sign up for my free newsletter because I send out emails all the time that help you navigate the markets. I love helping any way I can. Hope to see you all very soon.